Hi everybody, this is Lance from datatraders.com. This video I want to go over the Ironfly strategy, how we adapted it to make it a little safer, higher win rate, and mitigate our losses. We'll go over how to set up the trade and how to manage it when it's going against us. This is a good trade to do every day, and uses only about $350 to $400 in buying power, depending on the IV and the current environment. It's a pretty easy trade to do and could get some pretty good returns, as you'll see. All right, let's go. All right, so if you look at a previous video, I left it in the link in the description down below. We went over the Ironfly strategy and how to set it up. And those were doing 1 DTE trades, but looking at some of this back testing, I think it makes more sense to go further out in time. And you can also mitigate your risk this way a little bit easier, but still gets good returns. So what is the Iron Butterfly? This is where you're doing a neutral option strategy. You're going to sell both a call and a put at the same strike price, and then buy a call and put option at a higher and lower price respectively. So you're buying out of the money calls and puts as protection. The strategy generally generates profit when the underlying asset remains within a certain price range, and that's the profit zone, and it does limit potential losses outside that range because of the bought put and bought calls. So this is a risk return graph of the Iron Butterfly. Since you're selling at the money, short puts and short calls, this will be where our max profit is at expiration. We're not going to hold these to expiration. So it is a max profit here, but you're not going to actually get that max profit. So just be aware of that. And then you're going to be buying the protection by buying these long calls here and long puts here. We're also going to get out of the trade before it gets to these max losses as well. So we're looking for zones right around here and then possible stop outs around there. Now, how do we set these up? This is the updated way that we're doing it at Data Traders. So I like to sell them on 14 days out and do it during lunchtime, so I have plenty of time to do it. I don't have to worry about going in the middle of the day setting up these trades. And the market's typically quieter at that time. And then I'll sell the at the money calls and puts. I'm currently using XSP because it uses quite a bit less buying power than SPX. You could do it on SPX as well, but it uses a lot more buying power. And then you're going to buy the wings on the expected move. Right now, the current implied volatility in May 2023, we're looking at around a 10 width. So if you're going to sell like a 410, you're going to buy the 420 call and buy the 400 put. Here's an example trade. Let's say XSP is at 410.89 and the expected move is around 9.8. I usually go the nearest whole number from this. So 410.89 is really close to 411. If it was 410.1, 0.2, I'd go down to 410. If it's right in the middle around 0.4, 0.5, I sometimes go a little bit on the bullish side, so I might round up in that case, or I'll wait to see if we get closer to the nearest whole number. So 411, we're going to be selling these 411 puts and 411 calls. These do take in a lot of premium. For our protection, we're going to buy a little bit past the expected move. So we're going to buy 10 width away, 421 call and 401 put. In this example trade, I did get 6.8 in premium, so $680 in premium came in. The buying power is essentially 1,000, which is the width of the spread, minus the premium taken in. So you only need about $320 to do this particular trade. Now this is the Thinkorswim Analyze graph for a very similar position that we just entered. You'll see the same risk return graph here. The max losses, if we waited till expiration and it got to one of the wings, looking at around $380 in this case. But as you'll see soon, we're going to get out pretty much in this area or take profit around this area. So this max loss doesn't necessarily matter too much besides using up that much buying power. Now here's how we're going to manage the trade. We typically look for about a 10% profit in this case. If we took in $680, we're going to close it at around $60, $70 or so. So I'm going to set a good till canceled order at 6.2, 6.1, somewhere in that range. Look for 10% on our money because we take in 680 and then buy it back for 620, get about $60 there in that trade. And that's a good return for about $320 in buying power. What we do to manage if we're going against us, we're going to look at the break-even prices. This is where the green bar is right at zero. So right at expiration, we're over here. And the break-even prices for this particular trade was 405.71 and 418.20. If we touch either of these areas before expiration, if we touch these areas, we will be at a little bit of a loss because it could be down here or down here from the purple line. And this was the same day expiration of the purple line. As you go up into the future, the purple line will start to line up with the green line. So whenever this does happen, it will be a small loss because the break even is at expiration. It's going to be a little bit below that, but it depends on when it actually hits that price. We've only had one stop loss where I actually did that relatively quickly, and the other trades were pretty much taking our 10% profit. So these are the trades that we've started on April 19th up to the 12th. At thedatraders.com, we go over all this data that you could look at and analyze, and I'll enter these in real time as I alert them. So looking at 421, went up to 505. Stock price was at 411.28, and we went slightly higher at the 412. This would be slightly bullish leaning. So sold the 412 put and call, bought the 402 and bought the 402 put and bought the 422 call. Premium at the time 2.7. And expected move was 10. This is when we did them as debits. It's pretty much the same thing if you do them as debits or credits. In this case, we're just doing like the put side throughout. But we changed it recently to the way that I mentioned before. We're just going to buy the put that's out of the money, buy the call out of the money. So the premiums here are usually ranging between 6 to around 9 or so. Here we got 8.5 because the expected move was higher. But you'll notice the expected move is close to 10 in most cases. So we're buying about a 10 with in the wings. And here's the outcomes. For the outcomes, we did have 2 losses so far, and looking at $100, $120. The others were pretty consistent gains, and these are happening within about 1 to 3 days in most cases, even though we're 14 days out. Current win rate so far is 11 wins out of 13 trades. And for the total return, I'm just adding the profit losses, subtracted this loss, and we made about $322 on this trade so far in a little less than a month. Remember, this only uses about $320 to $360 in buying power. So easily scalable. Doing this with a relatively small amount of money here. You might have to use $320 for each day until it closes. So probably have at least $2,000 or so to do this particular strategy with. Just knowing that we're going to be getting out early or closing them out, then you should be able to do this with a relatively small account size. And this is the total profit loss statements, each day in blue. And this lost day here, lost day here. The rest are winner days. And the red bar is showing where our profits and losses are each day. And we're currently a little over $300 in this trade. So if you have any general questions on the strategy, we do a free 7-day trial at thedatraders.com. I'll alert the exact strikes that I'll be using, where the expected move is, what your premium are collecting. And then I also analyze and alert whenever I close these trades, usually around 10%. Sometimes I'll go a little quicker, like 7-8% if it happens within a day, which we did a little bit recently. Again, Lance from thedatraders.com. If you have any questions, feel free to leave a comment down below, and I'll see you guys on the Discord. Have a good one.